Asian equities have had a volatile start to the year, but the MSCI Asia Pac ex-Japan index has still finished up more than 4% for the first quarter in US dollar terms, and that's been largely thanks to a recovery in the North Asian markets. Looking ahead for the rest of 2023, I see four key areas to focus on. Firstly, the macro trends and what's happening in the global economy and the implications that has for Asia. Secondly, China's rebound post-pandemic and the implications that has for the rest of the region. Thirdly, the supply chain regionalization trend as a new structural growth driver that we're seeing in Asia. And fourthly, as bottom-up quality-focused investors, it's important to look at what's happening at the micro level amongst corporates in Asia. So I'll take the next few minutes just to briefly run through each of these points in turn. So turning firstly to the macro trends, the global macro narrative has changed in the first quarter of this year, whilst the fourth quarter of 2022 saw expectations rising of a soft landing for the US economy and a peaking of the rate cycle. I think the narrative this quarter has been much more uncertain, largely attributed to the collapse in Silicon Valley Bank and the takeover of Credit Suisse and the still elevated inflationary environment. And that makes the rate outlook much less clear. From a positive perspective, however, I think Asia is in a much healthier place. Inflation remains considerably more benign in this part of the world. The rate cycle has been less severe, and that's providing a more favourable backdrop for Asian corporates. And when we think about the impact of Silicon Valley Bank's collapse, our house view is that that's unlikely to pose a systemic risk, but it does raise the probability of a hard landing or recession in the US, and that will pose consequences for Asia, and we are expecting growth to slow and liquidity to tighten. But when you look at the Asian banking system and the fundamentals, again, we see much more resilience here. So it's less about the direct impact, more about the second order implications of tightening liquidity and slowing growth, and Asia won't be spared. So I think the outlook in that respect has got more challenging. On the positive front, when we think about what's happening in China, there's no doubt that China's reopening post-pandemic is a big tailwind, both for China itself and for the region as a whole. We see high savings rate and pent-up demand that should drive a material rebound in consumption in China. The headwinds that have been buffeting the internet sector have cleared, and that as a sector should be a major beneficiary of the reopening amongst other companies, and we're positioning portfolios around that. But at this point in time, it's still relatively tentative. We haven't seen this rebound in consumption come through in the numbers yet. The property sector in China, which is all important, remains somewhat fragile, although near-term numbers show some sign of improvement. But we are in a wait-and-see mode at this point. I would say overall, however, we do remain constructive on the reopening story and believe it will have very positive implications for China and for the rest of the region, in particular through routes like tourism, with many countries benefiting in the past pre-COVID from tourism from China. Turning to the third point and the regionalization of supply chains, the geopolitics between China and the West has been a headwind rather for investing in China. But one of the side benefits in a way of that is that we've seen multinational companies now look to diversify their supply chains out of China into other parts of the region. Beneficiaries of this include Southeast Asia, where we're seeing foreign direct investment limits or levels pick up, and India, which is directly targeting this sort of investment in supply chains and manufacturing through new schemes and policies which have had some early success. So we see this as a new structural growth story that complements other structural growth drivers that remain in Asia, like rising wealth levels, demand for increasingly premium goods and services, continued urbanization, and the digitalization story that continues to sustain attractive levels of economic growth despite the macroeconomic headwinds. And finally, turning to the fourth key focus area, and that is the bottom-up perspective and the micro trends. We think that 2023 is likely to be a challenging year for equity markets globally, particularly in the first half, and Asia will be no exception. But macro fundamentals are in better shape in Asia. with lower inflation, less severe rate cycle, and those structural growth drivers that I've mentioned. And the bottom-up fundamentals, when you look at those, also provide some level of comfort, with Asian corporate balance sheets in good health. If you look at net debt to equity ratios, they're well below US and European levels. Earnings growth is still coming through, and much of the uncertainty when you look at valuations for Asian equities appear to be already priced in, with Asia trading well below its long-term average multiples and looking cheap relative to developed markets and the US in particular. So in summary, we continue to believe Asia is better placed than much of the rest of the world, both from a macro and micro perspective. And at Aberdeen, we will continue to focus on quality, giving our portfolios the resilience that they need to weather any challenges that the global economic outlook may pose for the year ahead.